Tension, tension. I know. Okay, just let me know when y'all want me to start. Just give me like a. I don't know who's recording. Who should I watch? Just watch both of y'all. If y'all can give me a thumbs up when you're ready to get started, that'd be great. Oh wait, he put his camera down. Ready? Okay. Ready? Almost. All right. Perfect, perfect. Hello, good evening, everyone. My name is Latoya Tillet. I am the broker owner of Tillet Realty Group, as well as the CEO of Tax Plus Financial Services. What I do is I help my clients create diverse portfolios that include commercial, residential, and international properties while maximizing their tax benefits. All right, so what am I here to talk about today? Everybody's favorite subject. Let's talk about taxes. Yay! All right, so we're going to be talking a little bit about business taxes and what that looks like for you if you're looking to either be a sole proprietor or do it through an entity. Okay, so now what is a business? A business, as with the legal definition of a business is a definition is a business or natural person or entity performing an activity or trade with the intent of making profit. Okay, the intent of making a profit. So keep that in mind because we're going to come back to that a little bit later. So I hope you guys don't mind that I have my little notes here just because I haven't met anyone who's been able to memorize the 70,000 plus pages that make up the Internal Revenue Code. So definitely need to make sure I have my notes available for you all. All right, so one of the most common business practices that we see are the sole proprietors. What's a sole proprietor? That's someone who has not registered an entity with the state that they're in, for instance, like California, since we're here in Cali right now. So those people are called sole proprietors, and you generally will file your income and your expenses on a Schedule C attached to your 1040, which is your personal income tax return. Okay, not bad, right? So if you're an independent contractor, you receive a 1099. Like in real estate, as far as my real estate business, normally if I've worked for a big brokerage or now I work for myself, I either 1099 myself or I've received 1099s in the past. So if you have side gigs like, Uber, Lyft, those type of things, you get a 1099, those will go on your Schedule C. All right? What are the benefits of the Schedule C? None. To keep it short. So there's really no benefit to filing as a sole proprietor other than the fact that you do have particular business write-offs that you can use. Now, there are some people, which I do not advise that you do this, who do Schedule Cs and write off large losses to minimize their taxable income from their W-2 jobs. I do not recommend that you do that because if you do that for more than 3 years in a row, guess what? IRS is going to come knocking at your door like, hey, we need to look at your finances to see what's going on with this business. Why are you not making any money? It's been 3 years. Is this really a business or is this a hobby? Remember, as long as you can prove that you have the intent to make a profit, you can get around that audit. Okay, we could talk about that more on a one-on-one basis because there's just a lot into it and I don't want to take up too much of your time with that. All right, so one way that you can get around paying so much in taxes with being a sole proprietor or filing with the Schedule C is you could pay your kids if you have some. What do I mean by that? So if your child is under 18 but of an age where they can at least do minimal task or have understanding of what minimum task is, you can pay your child up to, for 2022, up to $12,950. And guess what? Neither you nor the child pay taxes on that money. Isn't that wonderful? So what have you done? Let's say you got 2, 3 kids. Like me, I got 3. So 3 kids, 3 times 12, what is that? I've just reduced my income by that amount of money. And so that way, you're only getting taxed on what's left over, which is your taxable income by the IRS. All right, so that's one of the advanced tax strategies that you can use to help save yourself some money on your tax returns if you're a sole proprietor. Keep in mind, in a sole proprietorship, you're paying both the employer and employee portion of the income taxes. So now you're paying about roughly 15.3% on any income that you make as a sole proprietor. So that's your cash income, your 1099, anything like that, you're paying double because guess what? The person who gave you that 1099 does not want the responsibility of filing your taxes for you. Alrighty, so moving right along here, some people might say, okay, so maybe I shouldn't be a sole proprietor. Maybe I should go get an LLC. So what do people do? They run out and they say, hey, I was told I should start a business so I could save on my taxes, so I want to open an LLC. All right, how many people in the LLC? Oh, just me. Guess what? You have not saved yourself a penny by being the sole member of an LLC. When there's only one member in the LLC, that is called a single member LLC. And guess what? You still file your taxes on the Schedule C, attached to your 1040, paying the 15.3% on the income. And then in addition now, since you've decided to be an LLC, now you created yourself an annual tax bill of $800 to the state of California because you want to be an LLC. So you haven't saved yourself anything. Now what you can do to help mitigate some of those tax risk is you can elect to be taxed as an S Corp or as a C Corp. So those are some different ways that you can kind of help to avoid taxes. So keep in mind, avoiding taxes is not illegal. Evading taxes is. What's the difference? We have the legal right to avoid paying taxes on our income as long as we do it in legal means. Now, tax evasion, that's when you purposely misrepresent your income and your expenses. Okay? So remember, you can avoid taxes, you cannot evade them. So keep that in mind. So that's why you see people like, Wesley Snipes went to jail before because of some tax issues. You got Shakira now going through her legal battle with some tax issues. So that's when we get more into the tax evasion phase of the IRS code. All right, awesome. So still keep in mind now, California, if you register your entity here, is $800, right? So what do most people try to do to avoid paying that $800? Incorporate in Vegas. And where do they handle their business at, though? Okay, guess what? You still got to pay the $800. No way around it. Doesn't matter where you go. You can go to Delaware, any Florida, Texas, Nevada, any of these states that don't have state income taxes. Guess what? If you're making money here and your income is landing here in California, you owe the state of California $800. But guess what else you owe? Now you have to pay an additional $100 to register your company as a foreign entity in California. So now you got, we're at $900 now? And then if if for God's sakes you have a profit, now you got to pay taxes to California too on that profit as well. So my opinion, if you're going to open a corporation, avoid the LLC if you can, unless you have more than one member, only because, you're still going to pay the $800 and you're still going to pay the self-employment tax, okay? So if you don't have two members, at least for your LLC, or you've opened that LLC in another state, you're going to still pay taxes here in California, and you're still going to have to pay to register your foreign entity here in California as well. So my experience with that, what I tell clients, I say don't do that. Why do you want to open an LLC? Why would anyone want to open an LLC? Oh, because I need a corporation. LLCs are like a hybrid. So they're a hybrid between you as a sole person and you as an entity. And that gives you some limited liability as far as when it comes to if anything happens. Like let's say the company gets sued or something like that. Then you have limited liability on the portion that you can get sued on. But if you're a single member LLC, you're a disregarded entity, and guess what? You're completely 100% liable for everything. So you haven't really avoided anything. And so another thing too with LLCs that, I'm not bad-mouthing LLCs. They're great, for what they're used for if you structure it properly and use it what it's for. In some cases, LLCs were kind of built back in the days to be kind of like a temporary corporation. So let's say me and Brianna, we want to go buy some properties. And then we're like, hey, we want to bring Ken and Ebony in too. So we can all form an LLC in the name of that property. And then when we dispose of that property and split the profits, we close that LLC out. So it's kind of like a temporary, tax shelter for the time being. And then we'll all split the proceeds or losses on a K-1, which comes to us that we report on our personal tax returns. All right, so I hope that makes sense for y'all. I know it's a lot, and just trying to get through it and not take too much of your time with it. And so let's see, where are we now? So one of the corporations that are my favorites, I do love S corps because you get the benefit of the write-offs, and then you also don't have the double taxation. So I know everybody talks about corporations and having double taxation. It's actually not that bad. I have an S corp and a C corp. And so with my experience with that, a C corp, you're a standalone entity, so that baby stands over there by itself, and it does what it needs to do. You only pay double taxes if you pay out dividends. So your shareholders will have to pay taxes on their portion of the dividends that they receive from the C corporation. And then, you pay taxes on any income that you make with the C corporation. So that's the biggest difference there. I know they try, when they're selling you these things like LegalZoom and some of those other companies out there, when they're trying to sell you on the LLC versus the C Corp or, however they word it to you, that's the biggest thing they throw out there is a double taxation, but it's really not that terrible. Especially, it depends on what you're trying to do and what your goals are. So that's one of the main things I focus on when talking to clients is finding out what their goals are, what are their end objectives to what they're trying to do with their business. And so that helps to determine the best structure that they should choose and that has the best tax benefits for them. All right, so I'm going too fast. Anybody have any questions right now? Bless you. No questions yet? Oh, sure. Oh, okay, all right. Well, we'll take a couple of them right now and then we'll move into another topic, but I just want to kind of round up that section for you guys and answer any questions that are right there for you while they're in the top of your mind.
Appreciate it.
Yes.
So I feel like there's a lot of confusion. Okay, thank you. I feel like there's a lot of confusion as it pertains to taxes, and I hear all the time, oh, you should get an LLC. So for real estate agents, should they be sole proprietors or have an LLC, or does that depend? What does that look like?
Glad you asked. Okay, great. So, realtors, it really just depends on what your goals are. Again, it would depend on what you're looking to do. Now, if you're a realtor and you're only closing a deal or two every year or so, nothing really big, then you could get away with just being a sole proprietor. Now, if you're a mega realtor and you're closing at least one deal a month, you might want to look at structuring yourself as not necessarily as an LLC unless you're going to have two partners. But you may want to look at either doing the LLC and being taxed as an S corp, or just going ahead and opening up an S corp. And then with the S corp, there are some rules you have to follow. And so if you do decide to register your entity as an S corp, you will need to do annual meetings. You have to keep up with your minutes, and then you can't. I know the income limit is about $250,000, so once you kind of start getting over $250,000 in revenue, you need to start looking at becoming a C corporation, which is really easy to transfer here in the state of California. I've done it personally myself, and so it's really not a terribly cumbersome process. You can do the LLC depending on where you're working your real estate. So if you're a real estate agent and you work for a brokerage like a Coldwell Banker, Century 21, those places, most of them will not pay an LLC. You would have to become a C corp for them to pay your commissions to that corporation, if that makes sense. So I've actually gone through that myself too.
Okay, so I am a life insurance consultant, and I have always been a sole proprietor. Last year, I decided to go ahead and get an LLC because I'm working on building up an agency. I did speak with someone because I feel like I've heard all different types of things on, oh, you should do this, oh, you should do that, and it's conflicting information. So I was originally told to get a C Corp, and then I was told, no, I don't need a C Corp, I need a S Corp, and then I was told I needed an LLC. So I literally have heard it all. And so, yes, I do plan on scaling this year, probably within the next 3 months. However, given my current situation, it's just me. And so, does it make sense to stick with the LLC, or does it make sense to actually progress since I have intentions on expanding?
All right, that's a really good loaded question. So, personally, I would recommend just really depending on your structuring and what you're scaling to. If you're looking to scale that quickly, I definitely will look at converting over to a C corp because that way, you have that business, it's separate from you. So, if there's anything that happens with that, anybody tries to come after you, then you got to peel those layers, and it's like an onion. You got to peel the layers to try to find Brianna. So as opposed to LLC, they could just look up and like, oh, Brianna owns that LLC. Let's go get her. So, yeah, I definitely, if you're looking to add, as far as building an agency and bringing in more people, it makes sense to just go with, all out with the C corp. And that's kind of what me and my business partner chose to do.
So, in which instances would I go with an S
You would go with an S corp if you are looking to start pretty small. Like um, let's say you were considering maybe not scaling so quickly and opening the agency, but not bringing on actual agents till maybe a year or so later. Then you could say, okay, I could start with the S corp right now. That way, I'm getting all the benefits of the write-offs. I'm receiving the maximum tax benefits that I can get from my company while you're still building or in the building phase. Okay? You're welcome. You're welcome. Anybody else, real quick? No? All right, perfect. So now we're going to look at. I had so many notes here written for you guys. It's just so many things to talk about. And so we already talked about paying your kids and everything. So partnerships aren't a terrible thing. LLCs are generally taxed as a partnership, like a general partnership. Or they actually have limited partnerships as well. So a limited partnership is where you're saying, me and Brianna are going to be limited to the amount of money that we invested into this corporation or into this business. So if I put in 40,000, Brianna put in 30, anything as far as liability and legal wise will be, we can only get, I don't want to say attacked, but we will only be sued to up to that amount because that's our limited liability. So I actually had a limited partnership before. It actually was one of the biggest mistakes that I think we made, considering what our goals were for the business. So when we sat down and we spoke with the CPA, both me and my business partner, knowing better ourselves because we do this. This is what we do. We help people structure their businesses. But because it's not always best to, just because you know how to do it, for you to do it, we went and sought outside counsel, and against our better judgment, we went with their recommendation. It didn't work out well for us at all in any aspect. So we ended up converting over to a C corp because that was just the best way to do it. It was an investment company, so our goals and the way that we wanted to handle things and the people that we wanted to bring in, it was best for us to do a C corp. So we ended up doing that conversion. That's why I was saying it's not really difficult to do that conversion. It's just like a one sheet, and you submit that to the Secretary of State, and you're able to convert over to a C corp. All right, perfect. So just taking a look at my notes here. So how many investors do we have in the room? All right, woohoo! All right, so investors, what are some tax strategies that you guys have heard about or that you try?
I think it's legal. Yeah, yeah. Get it at a low price, meaning if someone's like selling you a car, instead of selling me a car for 30,000, I buy the car for 3,000. Yeah, right. And then
Section 1031.
Yes, that's one of the best ones out there that they have for y'all. So Section 1031 exchange, what is that? As per the IRS code, is Section 1031 says you can exchange for a like property. So if you have an apartment building over here, but hey, you want to upgrade to an apartment building over there, maybe in another state or in another town, another county. You can do that as long as you identify that property within 45 days after the sale and you're deferring your capital gains tax. So that's definitely a good way if you're going to be selling properties rapidly, holding them less than a year or two. You definitely want to look at doing a 1031 exchange to avoid those capital gains taxes. All right. And so we're talking about taxes. And when you think about expenses, what are some expenses that you guys need to write off? Vehicle. Yes. Is it everything within reason? What about you, Brianna? What kind of expenses do you have to write off?
I try to write off everything, office expenses, food. I do write off food.
Okay. Okay.
I don't know.
All right. Perfect. Perfect. So, have you any of you ever heard of Section 162 of the Internal Revenue Code? No? Nobody has heard of it. Okay, great. Not a problem. Section 162 of the Internal Revenue Code states that you may write off any necessary and ordinary expenses that pertain to your business. Now let's break that down. What does that mean? Okay, I'm a realtor that shows oceanfront properties and I decide to buy a yacht and write that off on my taxes. What do you think the IRS is going to say? Right. So as long as I can prove within reason that I purchased this yacht to show my clients these oceanfront properties or lakefront properties, this is an ordinary and necessary expense for my business, right? So it's all about what you can prove because guess what? The burden of proof is on the taxpayer, not the IRS. So the IRS workers, they just follow the code, but it's up to you to prove to them why you deserve, the write-offs that you've chosen to do. So for your insurance agency, there's a general list of what's expected to be written off for an insurance agency, okay? So if something looks kind of out of the ordinary, they might say, we need to contact Brianna and send her a letter and let her know we want to take a look deeper into her business, see what's going on. So they're going to call you and they're going to say, hey, Brianna, we know that you have an insurance agency, but you're writing off stuff in, like other countries. Like, what's that for? And then if you can prove to them, hey, because sometimes I have to fly out and meet with clients who are in various areas looking for insurance for, let's say, their properties that they're purchasing internationally from Toya. No. But anyway, so you've gone to meet with them and take a look at the property to see if it qualifies under your insurance house. Hey, you just got a chance to visit a beautiful destination and write that off as a business expense, right? Right, nice, right? So these are just some helpful tips and tax strategies that you can use when looking to make sure or determine that the write-offs that you want to use actually qualify under the Internal Revenue Code. So keep in mind, when you guys get a chance, look up Section 162, take a look at some of those things that are in there just to get an idea of what it is, okay? All right, perfect. So I think we're almost coming down to the end of it. So we're going to go ahead and talk about some tax planning. So we want to talk about, actually before we get to the planning part, let's talk about some more employment and self-employment taxes and audits. Has anybody ever been audited before? No? Okay, you're lucky, you're lucky. I went through one and I actually helped a company go through an audit. Those are always fun. So that's when you get to pull out all your boxes of bank statements for 12 years or whatever they ask you for, some ridiculous number of documents that you're probably not going to have. And so we want to avoid an audit as much as possible. How do you avoid an audit? You keep good records. That is the best way to avoid an audit. So you want to make sure you're tracking all your mileage, you keep in all your receipts for your gas if you choose to use the actual expense write-off method. You want to make sure you keep in all your receipts from the restaurants, especially from 2021 and 2022, because those are 100% deductible for those 2 years. Now, starting this year, they're not. They're back down to 50%. But before then, if you're buying food from restaurants, it has to be from restaurants. They're 100% deductible for 2021 and 2022, okay? You definitely want to keep track of anything that's coming in. You want to track your income just as much as you're tracking your expenses. I've actually run into clients who could care less about what they made, that they want to make sure I know how much they spent. But I'm like, well, how much did you make? I was like, well, I don't know. I didn't really keep track of that, but I know I spent $20,000. And it's like, all right, well, did you make enough money to justify spending $20,000? That's a key thing. So it has to be a balance. You have to be able to prove and show to the IRS that there is a balance within your business and that you did make, at least enough money to cover your general expenses. All right? And so another thing you want to look at doing, of course, is making sure you're using some type of accounting software. So I know we're all on accounting, aren't accountants, but if you don't have an accountant, you at least want to use something like a QuickBooks or something out there that's easy for you to do to keep track of your income and your expenses, so that way you have the records to prove to the IRS when they come knocking at your door. Now, do people get audited all the time? Not necessarily. There are some types of tax returns that have more of a higher instance of audits than others, like people using the Schedule A deductions. That's kind of up there on the radar. The IRS looks at those a little bit more closely. People with Schedule C businesses, they definitely look at them a little bit more closely, especially if they're high dollar earners. Let's say they make over $100,000 a year, but every year they're writing off this business, writing off $70,000 in expenses. They're going to look at that, So definitely want to make sure you're flying under the radar of the IRS and keeping everything within reason. But as long as you have the records and everything to back it up, hey, you'll be good. So one of the things that I do offer for my clients is a look back or a tax return review. So we can review your past tax returns if you feel like, maybe you didn't get all the deductions you should have had, or there's something that you ended up finding out later on. We can go ahead and take a look at those tax returns and do a full audit of them for you and see if we can find you some more money. And we can do a 1040X, so that's the amendment form, and we can submit that to the IRS to reclaim anything that you may have missed on your tax returns. Actually, I'm doing one of those right now as we speak. All right, so I think that's pretty much all I have as far as the auditing and taxes go. So you definitely want to use all the vehicles available to you to lower your tax liability so that you can start to save more of your money, make more. You want to make the money, but it's really not about how much you make, it's about how much you can keep. And so if you can find the loopholes and the legal way to avoid taxes. Now, avoiding taxes is what you see, Donald Trump and, with Amazon and some of these other huge companies. They don't pay taxes most of the time because they figured out a way to avoid taxes. And one way that I've seen that they avoid taxes is they open a nonprofit. You may not know they own that nonprofit, but they donate to it every year. But I didn't tell you guys that.
You answered my question. I was just going to ask, how is it that Jeff Bezos can make billions of dollars and not pay a cent in taxes?
Well, one, he has an extensive payroll, because I know a lot of people that work for Amazon, and there's a lot of warehouses popping up here and there. You got drivers everywhere. People are signing up to work at Amazon left and right. So one of the biggest tax expenses he's going to have that he can write off is his payroll expenses. So when you have payroll expenses, you have the wages that you've paid your employees, plus all the employer taxes that you paid on those wages as well. So that's one way. That's probably like a huge portion of the income that comes from Amazon is in wages. Because I've actually met some folks that work for Amazon that make well over six figures, like 300,000, 500,000. I was like, oh, okay, that's pretty cool. I'm like, all right. So we got everybody from the warehouse worker making $18 an hour all the way up, the ladder and everything to some executives. So they have some really high salaries. So that's really one of the biggest portions of his income that he can write off. And then, probably has a nonprofit that he donates to. Or ooh, that's a deep one. I don't know. We're being recorded right now, so I might not get into that one right now. We can talk about that on the side. Sure.
taxes, there's different schedules. So can you briefly go through the different schedules? Is it like A through, is it Z? Or is it A through G? How many schedules are there?
All right, how many schedules there are in a tax return? All right, you got about 2 months to talk about it? Of course, there's your basic ones. You have your 1040, your Schedule C, your Schedule A. You have the 8867 form, and we can just go down the list of forms and forms and forms. So it's not necessarily a A to Z. There's, some forms that have letters. You got Schedule D, Schedule B, those like that. Huh? Yeah, you got Schedule K, so you got Schedule M, L, M1, M2. So it just really depends on your business. But not only do you have those lettered schedules, you also have thousands of form numbers that, like I said, we got about 2 or 3 months for us to just kind of sit down and go over about 8 hours a day for 7 days a week for those 2 months. Then, yeah, we can probably get through all of them. Sure.
So when you have rental properties that are cash flowing, how do you avoid paying taxes on that money?
Awesome. All right. That's a good question. So you can avoid paying that. And that's on the Schedule E. That's one of those other letters that's out there too. So you have the Schedule E that you will use to write off rental properties. Now that's if you own the rental property as an individual. You also use it too in your personal, not in your personal, but in your entity tax returns as well. But you use the Schedule E and you'll be able to write off all the expenses that you made the income from. So you'll put the income first, and then you'll be able to write off, property management fees, property taxes, pretty much everything that goes along with that rental property. And you'll be able to write that off on the Schedule E. Yeah. So that's how you do that to bring that income down and be able to avoid some taxes there. And so how many of you have worked for an employer where you get a W-2? I think we all have, right? And so you can utilize some of their vehicles that they offer as well, employee benefits such as 401ks. You may have IRAs or Roth IRAs that may be set up through your plan administrators through your employer, or if not, you can also definitely look into some of those different benefit plans outside of your employer through banks or retirement plan people who, actually put those together for you. So you can definitely use those to save on your taxes because you can do before tax deductions or after tax deductions. And then you can also do catch-up contributions depending on the vehicle that you choose. All righty. So, questions? Yes.
Okay, so with me building my agency, something that I've considered doing, because I'm 1099 with different life insurance companies, something that I've considered doing is turning myself into an employee and getting a W-2 instead. But I don't know if it makes sense to do that. I don't know if there's like certain guidelines that or something that I need to consider in order to make that decision, or what advice you can give.
Oh, okay. Awesome. So that's actually one of the topics I had on my list to talk about is paying yourself from your entity or your business. Setting yourself up on a W-2 is one of the surefire ways to avoid and save on taxes because, one, you're going to be able to personally have some type of taxes to write off or, have something to kind of mitigate any other income that you're making, right? Because you have the W-2, you're going to have federal withholding, Social Security, Medicare, FUTA, SUTA, all those folks, SDI if you're in California. So you'll have those write-offs personally. Now on your business side, if you pay yourself, let's say $50,000, right, on your W-2 from your company. Now your company is going to write off that $50,000 they paid to you. You own the company, keep in mind, you still own the company. But now you're writing off the wages that you paid to yourself as well as the employer portion of those taxes. So you follow? So now you've potentially lowered, let's just do easy numbers. Let's say $40,000, right? Like a $40,000, and you write that salary off. If you're an S corp or being taxed as an S corp, you're now reduced your taxes down to about $6,100 or so on the S corp side by doing the W-2, by paying yourself. Now what you've also done is lower the self-employment tax that you have to pay on the dividends that you receive as a shareholder of your S corp, if that makes sense. But it gets really deep, so we could definitely talk about that on the side. So I can show you some illustrations. Sorry, I don't have any slides here, but I could at least, show you some numbers and how they work, because me being a visual person, being able to see it makes me believe it. And so that's what I always like to show my clients and show them the numbers of what that will look like for them. Okay? Any other questions? Oh, okay. Y'all are a tough crowd. No, I'm just kidding. All right. Yeah, sure.
Okay, so my question is twofold.
Okay.
First part of my question is, I'm self-employed. Most of my income is 1099, and so I made about 50,000 last year. Is what I brought in for myself. I bought a vehicle. First part of the question will be, I'm not registered as an LLC, but I do have an EIN, and that's not on the bank account, but it's just one account. Okay, so that's the first question. Is like, what type of entity do I need to be in? Because now I'm producing more income than when I started. Then my second question is, I bought a vehicle last year that's mostly for business. Do I get a portion of that as a write-off?
All right, so you sound like you have one of those complex tax situations that requires in-depth consultation. So I could take a look at everything that you have and see what would be the best option for you. But just a kind of short answer, just to kind of give everyone else in the room an idea of what you've been looking at. If you have a car that you purchased primarily for business, it depends on how you're structured. Okay, so let's say you had an S corp or a C corp. You purchase that vehicle, right? You probably use your own personal credit and everything to get the vehicle, right? Okay. So one of the things you could do, if you decided to open an S corp or a C corp, you can transfer title or sell that vehicle to your corporation. So then everything related to the expenses of that vehicle is a write-off under the corporation, which is going to in turn save you on your personal tax side. So that's one thing you can do. On the other hand, there's also depreciation for purchasing the car. So you have depreciation, you have interest that you can write off from your car note payments, from your car loan and everything like that. That's an option. Or you can take the standard mileage deduction, which has been changed this year. They actually changed it mid-year of 2022. So in the first half of the year, it was 58.5 cents per mile. And then second half of the year, it's about, I think it's like 62.5 cents per mile for the second half of the year. So in most cases, I usually like to run the numbers both ways. I like to see how much, my clients spent in actual expenses like gas, oil changes, tire rotations, tires, maintenance, repairs, all that stuff, and compare that to the amount of miles that they actually drove and see which one's bigger. And in 99% of the time, the standard mileage deduction is the best option for you. So right now, because you're not, a registered entity or anything with the state of California, your best bet would probably be the mileage deduction for the business. But make sure you track your mileage. You keep a little mileage log. They have apps out there. I use one called TaxBot. And, when you jump in a car, hey, this is where I'm going. You put your mileage in there. It's real quick. Well, it's real easy. It also helps you track your other expenses. So if you go out and have lunch while you're out in the course of your business day, you upload those receipts and it keeps everything in there. That why I like that app and why I even recommend that app is because it was created by a former IRS agent. So he knows exactly what the IRS is going to be looking for. And so everything's built into that app. It's about $10 a month. So that's a good way to get started, to start tracking your stuff. It sure is. That's right off too. So I'll tell you another fun thing that I do. So I'm in real estate. So most of us are in real estate in some form or fashion, whether we sell, buy, or invest. Okay. So I invest and I also sell as well. I have my own brokerage. So I got into international sales. So I'm taking trips to the Dominican Republic, and I just became an ambassador of Mexico, so I'm going to Mexico, and guess what? I'm writing all that off. And I have so much fun, and I take my kids slash employees with me, so you can write those off too, right? So now we got plane tickets, we got food, we have transportation, all these things. There's just so many ways to save money on your taxes, but it's just all about how you keep your records. That's the most important part of it. Any other questions?
I've, yeah. So I've previously done Uber and Lyft. And you know how you said after 3 years, it's like you need to have some kind of profit? Well, they've changed. So 4 or 5 years ago, you could go out and work a weekend and come home with almost 2 grand. Now you work that same weekend, the same hours, and you're scraping for $800. Yeah, that much. Not including the gas, not including insurance or anything else. So, hello, it's gonna be a freaking loss. So, I previously was renting my car, then I purchased it, and now it's no longer. So, I have to write that off. It's gonna be a loss. So, what do you do to get around that? Because it's gonna be a loss.
Well, in your situation, you have your records, you have your proof. And fortunately, with Uber and Lyft and DoorDash and some of these other apps, driver apps like that, they keep track of how many miles that you're using while you're on the app. While the person's in the car. So it's up to you to track those outside miles that they're not tracking, like your mileage to that person, and then your mileage back from that person or in between people. Okay? So as long as you have the records to back up why you have this loss, you're good, because you're still doing this with the intent. Again, remember that. We talked about that earlier. You're a business if you're a person or entity who's operating with the intent to make a profit. So that's what I would say for that. So you definitely are going to make sure you have your records. You're going to write everything off that you need to write off. You're going to show, hey, this is an intent to write, to make a profit. Unfortunately, with the price of gas and the way that they changed their fee structuring, this is what it is. So you would be okay and protected in an audit. Yeah? Any other questions? I like to keep it interactive, since it's not too many of us here. We can talk back and forth a little bit. I know we have that other question from you. I'm still working on that in the back of my mind, but it's hard to say without knowing exactly what it is and what your goals are. That's the most important thing. What are your goals for your business? That's something that we would need to discuss to decide on your structuring. Okay? All right. Where am I at time-wise? 2 minutes. Oh, huh? 2 minutes. 2 minutes? Oh. Was there something? No?
Oh, I was just going to ask, what about, can you use Section 179 on a real estate deal? Buy appliances and that kind of thing?
Oh, yeah, good question. Actually, you can. So there's Section 179, there's bonus depreciation, and then there's also safe harbor de minimis. De minimis safe harbor. Sorry, I said it backwards. So de minimis safe harbor, that's for anything you purchase for your real estate property. That's under $2,500 for each item. So each item itemized has to be $2,500 or less. So what if you bought a whole bunch of $2,500 items? That's a way you can kind of write off some things. You can use the Section 179. Section 179 will give you the full deduction of that write-off in that year without you having to spread it out over time like you do with regular depreciation, where you're only getting a portion of it every year. Okay? Does everybody understand the difference between deductions and credits? No. Okay. All right. Well, we can talk about that a little bit because this trips people up every year. Hey, Latoya, I spent $10,000, but, I still owe and this is happening and, why I didn't get dollar for dollar for that? Because guess what? Deductions are not dollar for dollar. You only get about 40 cents on the dollar for every dollar you spend as a deduction. So your write-offs on your Schedule Cs and, different things like that, you're not getting dollar for dollar write-offs on that. So just so you guys keep that in mind. Now, a credit. A credit, there's 2 different types of credits within your tax return. So you have refundable and non-refundable credits. So a refundable credit is a credit that's given to you. It's like, say, hey, I'm going to give you this $5 here. Thank you so much for filing your taxes and paying on time, right? So that's a credit. They're giving you money back. Now, non-refundable credit is a credit that is exactly what it is. It's non-refundable. We're going to give you the credit, but it's only going to reduce your tax liability. So if you owe $2,000, and let's say you get a child tax credit, which is no longer a refundable credit, it's a non-refundable credit, it's just going to reduce your tax liability down to zero. So if you have like 2 or 3 kids, and let's say you get $6,000 in child tax credit, well, guess what? You're only getting $2,000 because they're going to take you down to zero, and then the other money is just there for show, pretty much.
What do you mean the child tax credit is no longer refundable?
It has changed. So over the past couple of years, the child tax credit was fully refundable during the pandemic for pandemic reasons only. So this year, people are seeing lower refunds because the child tax credit has reverted back to the way it always was, which was non-refundable. So there is a portion, though, and it's called additional child tax credit. That is the refundable portion of the child tax credit. But the whole credit, that's up to $2,000 per kid now, that's not refundable. It's just going to reduce your tax liability down to zero.
I don't know if this is really relevant, but how does the ERC work? Do you know what I'm talking about? Okay. Right.
Yep, know exactly what you're talking about. I am still researching that to find out how we can do that, but it works best for companies who actually track their payroll because you do have to submit and show that you did actually have employees that you paid W-2s. Yeah. Yeah, so that's why, employee retention, it's like, okay, that way they have a way to track it because I can log on to a software program right now and create a 1099. You can do it with W-2s too, but y'all didn't hear that. But yeah, that's one of the ways that they, track it because you have to have that file with the IRS too, your 940s and your 941s, all that good stuff. So you also want to make sure you have that in all your EDD forms and all that. So yeah. Yeah, so definitely, I'm doing a little bit more research on that one so I can find out how that can work for all of us. We'll put something together. Any more questions? What'd you say? Oh, okay. We can talk about that. Okay. All righty, so any more questions? I think we got a few more minutes here. You guys good? Huh? All right, well, if there's nothing else, no other questions.
Credit goes against your tax liability, right? Versus a deduction goes against your gross
Right,
rather than income, right?
right. So a deduction is going to reduce your taxable income. So like you guys have heard them throwing around the term the standard deduction that's in effect now until 2025. That we were used to being able to, people would say, hey, guess what? Me and my wife, we got 25 dependents because guess what? They're getting like $3,400 for each person they can write off. IRS said, you know what? We're not going to do that for a little bit. We're going to stop that right now until 2025. We're just going to give you one big lump sum. So we don't care how many kids you have or how many people you put on your tax return. You're not getting any extra money from them other than this amount right here. So single people, $12,950 for this year. Married couple, $25,900 for this year. So what a lot of people have been experiencing with those standard deductions, because it does just reduce your taxable income. So if you made $50,000, you're a married couple, you get the $25,900, you've just reduced your income by $25,000. So now you're only being taxed on the remaining $25,000, if that makes sense. You guys follow me? Okay. So that deduction, that's reducing your taxable income. With the standard deduction, most times people, when you used to buy your home, a lot of people would buy a home to purposely save money on taxes. Well, if your deduction, everything that you've spent on that Schedule A is not over your standard deduction amount, it kind of doesn't count right now, at least until 2025. After 2025, then we kind of go back to normal. That's if they don't extend it or change the rules, and you'll be able to write that off. Now, the credit, again, like I said, there's 2 forms. There's refundable and non-refundable. Credit, the actual refundable credit is, I'm giving you this money back. Thank you very much for filing your taxes and working. And then you have the non-refundable credit is like, we're just going to reduce you down to zero. So if it's a non-refundable credit at $8,000, but your tax liability is only $1,500, you're only getting the $1,500. and nothing, you don't get the extra money. So that trips people up a lot too on taxes as well. I see that. That's like, the number one question that's been this tax season so far, on the individual side especially, is why is my refund so low? That, that has been the burning question everybody wants to know. And apparently, the IRS didn't do a good job of letting y'all know that, hey, guess what? Everything we spoiled you guys with over the past couple of years, we ain't doing that no more. Sorry. They just took it away. And a lot of people, they weren't ready. They didn't know. They were planning to buy, cars or refrigerators or, saving towards the down payment of their house. You know what I'm saying? I used to tell people that too. Hey, get your tax return and put a down payment. Get your house,
So isn't that why we should be doing tax planning before January 1st?
You should be doing tax planning every day of the year prior to December 31st of that year. So if you want to start tax planning for 2023, you start today. You don't want to wait till the last minute because, one, you're going to stress yourself out. Two, you're going to stress your tax preparer out because you don't have all your stuff together. And so now you're like, oh, I don't have everything together. I need to file an extension. Now we're filing an extension. And then guess what happens? You got an extra 6 months to get your stuff together. But then you still didn't do it. So now you're scrambling at the end, telling your tax preparer, hey, just put something together for me. I don't have everything. So now everybody's stressed out because we don't know if these numbers are accurate or not. Right? And so keep in mind, you do have an extension deadline. So when you file your extensions for your individual tax returns, you do have to file those by April 18th of this year. If you have an S Corp, LLC partnership, you will file that prior to March 15th. So that date is coming up real quick if you have an LLC or S Corp or anything like that or partnership. That date is coming up March 15th. So you either have to have your taxes filed by then or have your extension filed by then. I know nonprofits, we got some nonprofits in the room. You guys aren't due until May 15th.
Do you do tax planning, or how do I'm not that smart, so I don't know exactly what to do for that, after I get nailed on April 18th. I mean, can we schedule an appointment with you and kind of go over what we need to do?
Yes, you can. I am now an enrolled agent. I have been in taxes for over 21 years. I know I started when I was 4. And so, we have a long line history of taxes. So, yes, definitely you can schedule an appointment with me, and we can start working on your tax planning. We can look at your previous year's tax returns and take a look and see what your history has been, see if we can find you any money in the past that you may have missed, and then we can move forward with planning for your current year. So, yes, I do tax planning as well. Any other questions? I think we're pretty much coming up on time. So if you want to make an appointment or you need to talk to me about a personal tax situation, I'll be hanging around here for about an hour or so tonight. If not, you can reach me at 951-263-7233. Or you can find me on Instagram. Who was that was on Instagram? Kind of like Conrad. You can find me on Instagram at Latoya Tillet. That's Latoya, T as in Tom, just like it's spelled, Illett. Or you can also find me under Tax Plus Financial Services, and that's with an S at the end, so that's Tax Plus Financial Services. That's also on Instagram or Facebook. All right, so yay. So you guys have fun, because I know talking about taxes and financing is so boring, so I try to make it fun for everybody, because I know it's not that and talking about, what you're going to do with your final expenses and everything. Those are two of the things we don't want to talk about. So I hope I kept it nice and light and entertaining, and we can dig into some of your personal situations later.